Hello, Brendan and Joey. How are you today?
Doing good.
Thank you. I'm looking forward to this presentation on how I can save on taxes, save from probate, and also do evil things. Is that going to be covered today?
Possibly. No, we're not going to get too evil today.
Oh, okay. Well, I'll probably then go ahead and watch a Disney movie or something while you guys perform. Bye, everybody. Okay. This is Alan Gassman. I'm here surrounded happily by Brandon Ketron and Joey Kleiner. I've also behind me got pictures of Professor Jerry Hesh, who's turning 80, I heard, very soon, and Bob Keebler, two personal heroes who have helped us a lot with our EstateView software. We are here today for 50 minutes to give you what I hope will be a very interesting and enlightening set of hypotheticals as 2026 approaches. So before I turn this over to Brandon and Joey, I'll mention that you will get credit for this if you're a Florida CPA or a Florida lawyer. If you're not in Florida, we'll be glad to give you a certificate of attendance that you can go ahead and post with whoever you would like. If you have any questions today, you can click on the upside down question pyramid, sing the song King Tut by Steve Martin, and put in your question upside down, and we will answer it with an upside down answer. Also, you have our email addresses here. Please, as always, send the easy questions to me and the difficult questions to Brandon and Joey, and they will get answered. We'll be posting this early next week to our YouTube website, which has a lot of videos that you can watch. And I want to mention next Saturday, we'll be back here and we'll be talking about similar topics, but I'll be talking about what to do with the family business in Orlando for the Florida Bar on Thursday. And then I'll come back to talk about what to do with the family business here on Saturday, July 20, giving you something definitely to live for. That's going to be a 3-part series on the family business. I'll continue the next Saturday and the next Saturday. So looking forward to that. We will mention about 174 times today the new EstateView estate tax planning software that we've been working on with Jonathan Blottmacher, Jerry Hesh, and Bob Keebler. If you're interested in the software, just send us an email and we can get you a free trial. We can sign you up for a workshop and we can give you a 5% discount or a cup of coffee at Starbucks, whichever costs more. So we really welcome your questions, comments, and suggestions on the software. We're learning how to use it. We're learning how to advertise it. We're learning how to sell it. So thank you for bearing with us in this regard. Page 9, you can go ahead and click on our library, watch the videos about the different calculators, and just have a jolly, jolly good time. So Brandon, I'm going to turn this over to you, and I'm looking forward to learning on where you ended up on some of these very interesting hypotheticals.
Yeah, so I think to kind of start things off, just, to set the stage a little bit is what are we talking about when we say the 2026 cliff? And what we're talking about there is the estate tax exemption being decreased to 1/2 of what it otherwise is today, starting January 1, 2026. This all occurred as part of the 2017 tax bill. The exemption went from $5 million adjusted for inflation to $10 million adjusted for inflation. But as part of that bill, in order to balance the budget and be able to get enough votes to pass, they had a lot of the provisions, particularly related to tax provisions that were favorable to taxpayers, sunset automatically 10 years down the road. So that is why we are here today, now getting close to 2026, when these provisions are set to sunset, meaning the exemption is going to go back down to the $5 million amount adjusted for inflation. So you can see here on our chart that we've put together, currently in 2024, we have a lifetime exemption and a state tax exemption of just over 13.6 million. That's going to stay there for 2025. It's going to be inflation adjusted, so it might be 14 million, somewhere around in there in 2025. But then after 2025, if nothing happens, it's going to automatically go down to 1/2 of what it otherwise is. So if it's 14 million in 2025, it will drop to 7 million in 2026 and thereafter. It'll keep adjusting for inflation, but we do have that drop. Now, do we know what's going to happen? We don't. You know, there's an election coming up. If the Republicans take control, I think it's unlikely that this provision would sunset. If the Democrats take control, I think it still might be unlikely that it sunsets because a lot of their large donors are going to be worried about the estate tax. So, you know, we have no clue what's going to happen, but that's what we're going to talk a little bit about today is, well, are we in a situation where we can go ahead and use our full exemption amount? That way it's done over with. And if it drops, we're in good shape. Are we in a situation where we're in the middle where we're not sure exactly what to do? Maybe we can set up some arrangements where we can quickly use our exemption or take that exemption back if we don't need to use it. So we can talk about ways you can structure trust and promissory notes to be able to set yourself up in a situation where you can use the exemption if you need to, or you can leave it alone if you don't need to use it if something happens where they're not going to change the estate tax exemption. Alan, Joey, any kind of initial thoughts there on what you guys think is going to happen here in the next year or two?
My prediction is that it will go down because Congress and a president will not get their act together, and that we really won't know until early 2026 whether they're going to put it back up or not. That's my prediction. And my prediction is that we're going to be very busy the last 3 weeks of December 2025, but the best results are going to go to the people who plan with us or their planners this year, who convert discountable assets to a promissory note and are ready to transfer away or forgive that note next year. Any disagreement with that?
You know, I like that.
I was just going to add that it is important to give it time to set up the new trust and really have that seed capital in there. That way, when you do a sale or a large gift later, it's already been marinating for a little bit.
That's right. By the way, most of you know me and you know Brandon. Joey Kleiner clerked for our law firm while attending Stetson Law School. Before that, he was an investment advisor with a large investment advisory firm. And now we're very excited for him. He's been admitted to Georgetown University LLM and tax program, and he'll start there in a few months. So I know, Joey, you're going to have every success, and I thank you for all the work that you've been doing for us, especially since I forgot to tell you, but you're working for free. So what's next?
Yeah, so this is just an example slide that we use to explain how all this works. So, you know, we have an increased exclusion. So let's say now it's 13.6 million. You make a $5 million gift and your exemption is down to 8 million. Then 2026 comes along, it does drop in half. Do you still have your part of your exemption lost and you just use that bonus exemption off the top? Or does that actually use a part of your standard exemption to where now you would go from, say, if it's a 7 million exemption, you've used 5 down to a $2 million exemption remaining? And unfortunately, it's the latter. The exemption that we typically would have, our normal core exclusion that we're calling it there, has to be used in full before we get into using any part of the temporary exemption. So what does that exactly mean? Well, it means that we have to use all of our exemption, essentially all 13 million, to be able to take advantage of this kind of increased exclusion. If we just use 5-6 million, then we're going to be left with nothing left when it does drop in half. So that's where the planning gets a little complicated. If you have a $200 million client, you know, it's easy to say I can give 13 million away and use this full exemption. If you have a $20 million client, are they going to be comfortable giving away 13 million and stuck with only 7? Probably not. So that's a more difficult conversation, you know, to have, and where you have to start running some of these numbers, setting things up that are flexible, that you can maybe get back into later if you need to, making your spouse a beneficiary, using a spouse limited access trust. So that's what we're going to be talking about a little bit today. And I just want to go through a quick example here to kind of drive that home with Mrs. Jones here. who has a $21 million estate. She's used 2.6 of her exemption already, which makes it nice and round for an $11 million exemption remaining. She makes that full $11 million gift. Her estate's now down to $10 million. She dies not too long thereafter and pays estate tax of $4 million. Now, if she had done nothing and didn't use that exemption, then 2026 comes along, the exemption goes in half, and it's 7.6 million. She's used 2.6 already, so she has $5 million remaining. She dies, pays estate tax on 16 million, her $21 million estate minus the 5 million of exemption remaining, pays 6.4 of estate taxes. So by using the exemption early while she had it, using that bonus exemption, she was able to save $2.4 million of estate taxes. But the problem is, if you go to the next slide here, if she'd only gifted, say, $5 million in 2024, go to slide 16, Alan, sorry.
All right.
Well, there we go. Then, you know, when the exemption drops in half, she only has 2 left. So that kind of shows that Miss Jones here, you know, you have to use that full amount to be able to get any advantage in this situation. And it's where, you know, client situations like Miss Jones, who only have $21 million, may not be able to use it all. And as we'll show in some of the hypotheticals, you may not have to. Just because you can doesn't mean you have to use it all. There's other strategies that you can use to minimize and actually zero out the estate tax. And this is another interesting part of this whole planning here for 2026 is this concept of a step transaction doctrine, particularly when we're trying to use spousal limited access trust, where one spouse will set up a trust for the benefit of the other spouse and the children. Now, in order for that other spouse to safely be a beneficiary, then they cannot be considered a contributor to the trust. So when you have a situation where assets are split evenly between a married couple, it's not as simple as I just transfer all the assets to one of them to the husband, for example, and then husband sets up a slat for the wife using all of his exemption amount. Isn't there an argument there that half of those assets came from the spouse and she was a contributor to the trust? That argument's been made before, so we have to be careful there when we structure these types of things. So there's ways that we can move assets to one spouse or the other, particularly ones that we would want to fund to a spousal limited access trust. You know, for example, you could give a promissory note. Say I own half of the business and my wife Emily owns half of the business. I could actually buy half of the business from Emily in exchange for a note, and then therefore 100% of the business is now owned by me, and I can put that into the slat for Emily and my kids. And then pay Emily, you know, a promissory note. You have to pay interest on that on that note. That interest is taxable between a husband and wife. It's not a disregarded transaction, even though there's no gain recognition. The interest is not disregarded, so you do have to kind of be careful there. But that's one way to do it. The other is if you have, you know, significant assets in one spouse's name, then they're the one that makes the gift, and you don't split the gift. So that way, you're taking full advantage of husband's exemption, where wife still has her exemption remaining that you can plan with later. But there would be no need to split the gift if it's only going to use, you know, half of each spouse's exemption. Alan, any kind of thoughts there on the step transaction aspect of this and what we've done before with clients to structure this?
Yes, I'll mention also that a lot of law firms, a lot of advisors will form a spousal limited access trust for each spouse. And we just don't think that that's safe. So we typically will have one spouse do a spousal limited access trust and the other do a descendants trust. And you have to be thoughtful here of which spouse is likely to die first, which spouse is going to need income. You know, typically in a common marriage situation, the bread earner spouse is 5 to 6 years older than the lower earner or zero earner spouse. The bread earner spouse is usually less worried about running out of assets. So typically that bread earner spouse is going to form a spousal limited access trust and gift his or her exclusion amount to that trust so that the beneficiary spouse can have access to those assets if the couple needs them. So that's where a married couple with 20 million, do you have that bread earner spouse buy 10 million worth of assets or 7 million or 8 million worth of assets from the other spouse and then make that large gift to the slat using the bread earner spouse exemption? And that's what we're going to talk about today. But then you got to also consider who's got the longer life expectancy. What if the non-bread earner spouse has a very short life expectancy? And you have to consider the psychology of all of this. And what I was thinking about where you were before with Mrs. Jones, she's probably going to be happier if you get her involved with drafting her trust and making her these decisions tentatively this year, as opposed to meeting her for the first time in December of 2025. So ask a question, get 4 answers. Sorry about that. On to the
Yeah, so I think next I want to just move along to these slides that Jerry and I have been presenting, kind of illustrating the grantor trust burn. And what am I talking about when I say that is when we make these decisions on how much to gift, not only are we worried about, am I giving away too much kind of immediately, right? We can't give away everything. We have to keep some money back for personal expenses moving forward. But we also have to be concerned with the fact that most of these gifts are made to grantor trust. And under a grantor trust, the grantor has to pay the income taxes on behalf of that trust. Particularly when we do an installment sale with a note that we'll get to in the next slides here, you almost have to have grantor trust status. Otherwise, you have some pretty adverse income tax consequences that could occur on most of these transactions. So it's not necessarily a case where you can immediately turn off grantor trust status sometimes. So we have to be worried about these tax obligations moving forward for a number of years, because they can kind of significantly deplete an estate, which can be a good thing if we have plenty of money left, but it could also be a bad thing if we're starting to run out of assets. So we want to make sure that people understand the impact of the burn, and then ways you can kind of minimize the burn or convert the trust to where the trust pays its own taxes some point in the future. But these are things you have to plan for. So this first scenario, and I think this is all part of getting an interesting point too, of helping us understand what clients can afford to give away the full exemption amount, and then what clients are better off with. Maybe you just need a small gift to take care of the estate tax. It's interesting kind of scenarios here. So this first one is a senior age 70. He's got $20 million of assets. He spends $500,000 a year, and he's trying to come in and use his full exemption amount. So we say, okay, are you comfortable with a $10 million gift, giving away half and keeping half? And that sounds like a reasonable plan. You know, that doesn't seem too far off. It's a gut reaction. But when you run the numbers on this, as you can see here, by kind of being not responsible for those payments of income taxes plus his personal spending throughout the year, you know, at age 86, he has now ran through completely that $10 million of assets. So we would either have to turn off grantor trust status here at some point. We would have to give away less. We'd have to maybe invest the trust assets and stuff that's not producing as much income to save a little bit of taxes. Maybe the grantor could be added back into this trust, but there's things that we'd have to do here other than simply just giving away $10 million, because the grantor runs out of money, and not going to be a happy client if they're running out of money at age 85. So then what if, running another scenario, what if we only gave away $6 million? Let's see what the results of that look like. And here, giving away $6 million, the grantor's estate, as you can see, at age 95, he's got $65 left. So this would be a perfect estate plan if we knew that they were going to die at age 95. Some clients would be completely comfortable with this and say, yeah, that's fine. I could borrow money back from the trust if I need to in those last couple of years. Maybe it's something I could be added back into if I need to. There's things we can plan if we get to 95, right? Others may say, no, my dad lived till he was 102. I think I'll live to age 100. Well, in that scenario, maybe a gift of only, say, $4 million would be more appropriate. That would leave us $4 million, just shy of $1 million at age 100. That's something a client might be more comfortable with. So this shows the importance of having software, having your own Excel spreadsheets, or using EstateView or something similar to run the numbers. Because it surprised me when a $20 million client gives a $4 million gift, and with the grantor trust burn and their consumption actually is pretty close to running out of assets by age 100. So, Alan, Joey, any thoughts on those scenarios?
Well, I want to say that it's really important to show the client what the burn is. So you see that middle column there, the income tax burn. Not only are you getting these assets, this 4 million out of your estate, but your estate is getting reduced by these amounts every year and the growth thereon, because you're going to pay the income tax on the trust income. But Brandon, would he be better off, or she be better off, going with 6 or 10 and just toggling off grantor trust status and letting the trust pay its own tax? Is that what you're about to show us?
Yeah, those are some, I didn't drag those slides in, but we do have those slides in the longer deck that Jerry and I presented. But yeah, that is most certainly an option. Is we get, in this scenario, your investments get down to, say, 10 million at age 90. Maybe we pull the trigger and have the trust protectors or the grantor releases swap power and turn off grantor trust status at that time. So then the trust pays its own taxes, and now all we have to worry about is personal consumption. To kind of, and 10 million would cover that. And we can run numbers again at that point in time to say, yeah, it's time to turn off grantor trust status. Let's go ahead and do that. So.
Okay, Joey, any comments?
Yeah, just to chime in here, I want to mention the income tax is assuming that all the growth in these trusts are taxable. So it is something that really, this is the worst case scenario, and that's how you want to do your planning, just to make sure that if everything is taxable, you are going to be able to have assets at the end. And then I did want to mention there is a comment or a question we got here talking about the married couple's assets. If it's mainly in retirement accounts, how does that affect planning? Are you able to still give those gifts, or is that something they should think differently about?
I think that's one that you have to run the numbers on. We actually ran into a situation with an elderly client not too long ago where we were actually setting up a self-canceling installment note for this elderly client. Had a decent life expectancy, but I think everyone knew that she wasn't going to live to her full life expectancy. And so we set up the self-canceling note, and as part of that, we actually liquidated part of the IRA, paid the tax early on that, and put it into the self-canceling installment note sale, because that saved a pretty good portion of estate taxes on what otherwise would have been taxable in the IRA. Other situations we've ran numbers on where it didn't make any sense at all to liquidate the IRA early. It was just, probably pay the estate tax on that, or try to get rid of everything else, live off your IRA, spend that baby down, and then maybe minimize estate taxes that way. But great question and great point. It is hard to plan when you have a significant portion of your net worth in retirement plan assets.
And it tilts the scale towards converting your IRA to a Roth IRA if you're going to pay estate tax on it. Sometimes it's better to pull that money out of the IRA early, get the income tax paid. You're going to pay it eventually, and then go ahead and get your estate tax stuff done. And then also ask the client about charity, because understanding that Uncle Sam's going to take a lot more than half of this IRA, do you want to go ahead and have the IRA payable to a charity that your children can control? So
just on that note as well, the assets in those pre-tax accounts are going to use your exemption as the current value in the account, even though you're going to pay tax on it later. So it actually uses more of your exemption than the real value you get out of those accounts. So sometimes that is a motivating factor to pay the tax now and use less exemption later.
Okay. So Brandon, how do we get rid of the burn? Do we put aloe oil on it?
Yeah, right. Put some good lotion on there, get some aloe vera. Yeah, No, there's a couple of different ways. Tax reimbursement clauses, we're not a huge fan of that, but it can be used where you give the trustee discretion to reimburse the grantor for the taxes paid on behalf of the trust. That's something that the law basically says that if there's an implied understanding that the trustee would reimburse the grantor, then that's going to cause the trust to be included in the estate. And then that's what we get worried about, is if that clause is there and the grantor asks, is the trustee really going to say no? Is there not kind of an implied agreement always? And how do you prove a negative? So we typically don't like this, but it is an option. The interesting part here is there was a recent case, which I'm sure maybe Alan's mentioned in the past, is quite commonly people would go to court and reform trust to add reimbursement clauses. And beneficiaries would consent, trustee would consent, court would sign an order, we're adding this reimbursement clause, and then the grantor could be reimbursed. Well, the IRS just came out and said if the beneficiaries consent to that, they're actually making a gift back to the grantor. And we're not going to tell you the value of that gift, but it is a gift. So that's something to watch out for. It's not something you can do after the fact anymore with a court petition, because there are gift tax consequences, at least according to the IRS, associated with that. So number 2, terminate grantor trust status. You can draft for that, put provisions in the trust document, maybe name trust protectors that can turn off grantor trust status. If you have a promissory note, which we'll talk about in the next slides here, you could increase the interest rate on that note. It doesn't have to be just at the minimum rate at the AFR. If you need more money coming back to the client, maybe you charge a higher interest rate. Maybe it's a self-canceling installment note that has a risk premium attacked onto that, so more money's coming back. 4, you can look at the investments of the trust. Maybe we just invested municipal bonds that doesn't spit off any income. That minimizes taxes. Put money into life insurance, tax-free. That's another way. All those assets that are actually pulling out income, maybe that's what we distribute out to the beneficiaries that need money. That way the grantor is not paying it. It gets into the beneficiaries' hands and they start paying it. A couple of others here that are noteworthy. We could, again, if it's a slat, we can make distributions to our spouse. It's a joint income tax return. The spouse could pay at least half of those taxes. We could have the client be able to come back in to that trust if it's in a asset protection jurisdiction. We could prepay notes if we have an outstanding note. So there's a number of ways here that we could use, kind of planning to reduce the impact of that burn, but definitely something to consider as part of your estate plan, and definitely a conversation to have with the client as part of the plan, so that they know that they're going to be obligable for these taxes in the future.
So Brandon, if I was going to do a $10 million note and the interest rate is 4.5%, and the client would like to get 6%, then I guess I could make part of that note a high interest note, self-canceling on the client's death, and then a separate conventional 4.5% note. That way she gets the cash flow she wants, and if she dies, we get a nice reduction of the note. Or I guess she could put in part for a promissory note and in part for a lifetime private annuity payment, right? Which we can calculate. Okay, so Joey, do we know how to deploy the polling question? Okay, well, I guess we deployed it. So here's the polling question, and if you're a CPA, you can answer this. If you're a lawyer, you can laugh because you don't have to answer this. What feature would be the most important to you in estate planning calculation software? A, a comprehensive estate tax analysis. B, the calculations you normally do on other software, like finding out the tax deduction, the gift value of a CUPERT, or what the payments of a GRAT have to be, or what the payments of a charitable remainder trust need to be. C, generating PowerPoints and letters for clients. Is that more important? D, nothing. I don't care about any sort of software. Or E, I'm glad to take a survey for a free donut and coffee, which Joey will bring to your office as long as you're somewhere in the state of Florida, or within 10 miles of a university that has an SEC accredited football team. So those are the polling questions. We've got enough answers here. So Joey, can we go back or go to the next thing? So here's where a lot of clients get surprised when they come to see us, because they say, okay, I'm here with my $30 million estate to try to find a way to give away $13,610,000, and they're grimacing about it. And we say, well, you know, we might just be able to do a couple of installment sales and you won't even need to use that part of your exemption if the numbers work out right. So Brandon, do you want to take the lead on this and explain how this happens and what numbers you would run?
Yep. So just to kind of introduce it here, there's a number of ways you can structure installment sales, and these kind of go through all the different variations. I won't cover it too much in detail here, but for example, this is a 70-year-old client. They could do a long-term note at currently 4.4%, which is the, I believe, May AFR, or maybe even April, because when we're doing this transaction, we can use our current month or the prior two. Obviously, we would pick the lowest one, and whichever is more favorable for the client. So this 4.4% could be used, even though the actual rate in June is more like 4.7. If you want to use a SCIN, this is a 70-year-old client. The premium on that is just about 5%. So that 9.25% note would be what you would have for a self-canceling installment note. And that's a note that if you die during the note term, automatically disappears, is not included in your estate. So it's a play on mortality and can be very beneficial from an estate tax standpoint if the client dies shorter than their life expectancy. And these rates kind of continue to just creep up very so slightly over the last year or so. It's interesting. When I first started practicing, the rates were, you know, very minimal, and it was very easy to say, yeah, let's do an installment sale. Can you beat a 1% rate of return? Yeah, I think I can do that. But now we're getting to where it's like, it's a little bit harder. We may not win out as large as we did in the past with some of these, but the basic structure of the installment sale is this, is you have $20 million worth of assets in an LLC. It's bifurcated into voting and non-voting interests. So we have 99% non-voting and 1% voting. The client hangs on to the 1% voting, but sells the 99% to a trust. Husband can sell his 49.5% to a slat. That would be for the benefit of the wife and the kids. And then the wife, as Alan mentioned earlier, we can't also do another slat. That trust is just going to be for descendants only. So the value is $20 million. We can discount it because it's a non-voting interest to around $14 million. So for a $7 million note approximately, the client is selling that interest to the trust. Now the trust owns the interest, receives all the income, receives all the appreciation. They just have to pay payments on this interest rate or this interest only note over a number of years. So what happens in 10 years from now when the assets have doubled in value? Let me go to the next slide. There we go. So now it's worth $40 million. The undiscounted value that's held under the trust for on the left-hand side of the slat is around $20 million. It owes this note back of just under $7 million and has a net value of just over $13 million. So we've made a $700,000 gift to this trust and sold assets in exchange for a $7 million note. And in 10 years' time, we've been able to pass $13 million of appreciation outside of the client's estate for a $700,000 gift. Pretty good deal, pretty good structure. And this really freezes the value of the client's estate at the interest rate on the note. And that's what we do for a lot of clients. And what that is setting up is it gives them a lot of flex. It's freezing the estate today, gives them the flexibility knowing that they have a note with interest payments coming back to them annually that they could use to live on. And then if they need additional money, we could prepay the note. But what that's setting up is what we like to call the Biden two-step. Is we set up this installment sale transaction. If nothing happens with the estate tax exemption, we may just keep this in place for the full 20 years, if it's a 20-year note, and freeze the estate that way, and then maybe do gifting later. If the exemption is going to drop in half, what we could do is pull the switch and forgive these notes as a gift and use the exemption that way. So that's how we're creating the flexibility, is if nothing happens, you have this note owed back to you, you can use it to live on, but if we need to use your exemption because it's going to go away, this is an asset that we can easily forgive and gift in 1 day's time, as long as the structure is set up and in place. It's a document that you sign saying, I hereby forgive this note as a gift, period, and then it's done. The other thing about this is you might even get another little bit of discount on the value of this note when you forgive that as a gift, because these notes at the applicable federal rate aren't necessarily, if you look at the market rates, it's probably a little bit below market from a willing buyer and willing seller standard, which is the standard being used to value these notes. They're interest only notes, or they're not amortized, so it's going to be a long time before you get this money. So, you might get a valuation expert to say that this $7 million note is not worth $7 million, it's only worth 6 or 5.5. And that's the value of our gift. So we can maybe get a little bit of extra valuation discount there, and give a nice bit of flexibility kind of for the client to forgive this note very quickly or in a short period of time if something happens to the exemption. So Alan, any Joey or Alan, any comments there?
I'll be covering, I think, next Saturday, the incredible power of the installment sale when you have a business that's paying dividends or distributions of profits. Because the numbers of these on these installment sales can just knock your socks off. And it's so powerful that you can afford to pay a higher interest rate and make them self-canceling until the burn sucks down the net worth of the family. And I think we can show that in the second half of this webinar for those who stick around.
Yeah.
The other thing, Brandon, is I'm wondering, we have, as you know, we have many clients who have these 1% and 2% long-term promissory notes. I'm wondering if some of them would be well served by swapping them for a 4.5% note with a smaller face value. Because then when you forgive the note, you're not taking a discount necessarily. Or when you die and the IRS looks at the value of the note, instead of having to explain, well, I need a big discount because it's a 1% 18-year note, might be better to say, well, it's a 4.5% 18-year note, and it's, instead of 10 million, it's 8 million too. So we might want to start reducing the principal amounts of the notes and bringing them to fair market value.
Yeah, that's not a bad idea. And that would, just like you would go negotiate with a bank, right? It's just the trustee negotiating with the grantor to decrease the face value for an increased interest rate. That
right.
Seems fair to me.
And then another thing is, if you're just going to let the installment sale suck down the assets because of the burn, you could make it a joint and survivor SCIN. So for example, you take 2 65-year-olds and you want to do a self-canceling installment note on a 65-year-old, maybe it's an extra 4%. But if the note only cancels on the death of the survivor of those two, then it might only be a 1.5% or 2% excess amount. So we should show this audience, when we're done with the PowerPoints, how that might work.
Yeah.
Because I think that's, especially the 2 client couples that we talked about this week, I think joint and survivor SCINs is going to probably be a good answer for them.
Yep. So that Biden two-step, I think, is one nice strategy that we're employing for a lot of our clients that are in this middle ground. let's set up these notes. We can forgive the notes. Even our large clients, actually, we've set up with an installment sale and said, you can forgive, even if it's a $50 million note, nothing says you prevents you from forgiving 13.6 million of this $50 million note to use your exemption. And that's a gift that's easily valued. Doesn't look too conspicuous. You're not taking a large discount on non-voting interest in a business entity that who knows what that value could end up being. And then you're also maximizing it because it's a discountable asset and you're not just having to forgive cash. So it's a good play and a lot of flexibility there.
Okay, so then the next polling question is, how do you determine what tax planning techniques your clients are using? A, which I think most people do, I'm using common sense and what I normally do, which is not necessarily the best answer. Then B, which should, but I'm sorry, they're misnumbered, running the numbers and discussing the numbers with the clients, which is what we recommend. C, relying on other advisors, which makes good sense as well. Or D, not applicable to me. So it looks like 12% of the audience, or 14%, are using common sense, 54% are running the numbers, 20% are relying on other advisors, 13% non-applicable to me. So thank you for that. That's very useful information for us. So Brandon, do you want to go over the lifetime Q-tip trust now?
Yep. And I think this is another one of those, what happened to our slides? But it's another one of those vehicles that are flexible, right? It's the idea of I can put money into this trust that has certain features, namely that it is for the sole benefit of the spouse and that it can pay all income annually, at least annually, to the spouse, so that it is Q-tippable, I guess you could say. And if you can Q-tip it, it means it qualifies for the marital deduction, meaning that it's not going to use any portion of your exemption amount by funding it. And so the idea would be I put the $13 million into this Q-tip trust or Q-tippable trust, but I don't immediately make the election to treat it as a Q-tip or qualifying for the marital deduction. I wait and see. I wait and see what happens with the election, wait and see what I can hear in the tea leaves from Congress if something's going to happen to the exemption, because I make the Q-tip election when my gift tax return is filed, and that's not due if I make the gift in 24 until April of 25, and I can extend it to September, October of 25. So we have a much longer period of time to make that decision, and it's not an all or nothing decision. It's something that you can make the election. So I'll go through the examples here. You treat your entire trust as marital, in which case it doesn't use any of your exemption. This would be if nothing happens to the exemption, right? It stays at the current $13 million. I didn't need to use it. I treat it as a marital deduction trust. Maybe even the trust protectors have the ability to just terminate the trust and give everything back to my wife. So it's a no harm, no foul type deal. The other option would be I don't make the Q-tip election. I treat it all as a completed gift made back in 2024 when I actually funded this trust, and that uses my exemption amount. Or if I have a situation where I'm not sure what the value of this asset necessarily is, I can use a formula clause and make it a partial Q-tip and partial completed gift. So I hereby elect Q-tip treatment on a portion of the trust that equals my estate tax exemption, and the numerator is my estate tax exemption, the denominator is the full value of the trust. So 80% might become a Q-tip, 20% might be a completed gift. And then as the IRS revalues that asset, it would flow to the Q-tip portion that would qualify for the marital deduction, so we know exactly how much of our exemption we're using. And so that's a nice way to buy a little bit of time if we are trying to still make the decision of whether or not we want to use our exemption amount. Alan, any comments on the lifetime Q-tip?
No, I think it's important to note that it will be available in 2025. Make a large gift to the Cupid and then decide in 2026 in September of 2026, if you do it right, you would have until that long to decide whether this CUPER is a gift using part of your exemption. It has to pay all income to the spouse, so it's leaky as compared to a typical irrevocable trust, but it does give you two really nice advantages. One, you can wait till September of 2026 to decide whether you made a gift or want to get it back. And then secondly, you can use a formula Q-tip election. So to try to make yourself more estate tax proof, because you would say, I hereby elect that any excess over 13,610,000 of assets under this CUPER goes to the marital part for my spouse, so I don't have to pay estate tax if it turns out that the IRS says that what I gave to this CUPER was really worth 15 million, if that makes sense.
Yeah, it does. And Alan, I don't know if we know the answer to this question for lifetime Q-tips, but I know at death you could make it, if you make the gift completed and send it to the credit shelter trust, it doesn't necessarily have to pay all income to the spouse. It can almost change at that point in time to not be as leaky as a typical Q-tip would be. Can we do that in lifetime as well, or are we not sure?
Thanks for the easy question.
Right.
The IRS said you couldn't do this at all until the Clayton case was decided.
Right.
The Clayton case was a death case.
Right.
And the court allowed it. Then the IRS updated their regulations, but only as to death. Okay. So if you try to do a Clayton Q-tip after death, you can expect the IRS to fight it. You've got the case law on your side to some extent, but who wants to fight with the IRS?
Yeah. So yeah, probably not the best plan to try to convert it to a non-leaky income-only trust. Just keep it income-only for the spouse's lifetime and deal with it. So that's kind of the trade-off for the flexibility, is you will have a little bit of leakiness outside of the trust because of the income having to come out.
Now, Brandon, in fairness to the attendee, you have another 10 minutes here to go through the hypotheticals, as opposed to, because we said 50 minutes, but I don't think anyone's going to be too upset with us if we go a little bit over.
Okay. Yeah, I don't think, so the hypotheticals, I think we have 4 here. And the first one we're starting out with is married couple. They've done no planning. They're earning about $300,000 a year after kind of taxes and expenses until they were going to retire in 10 years. And then when they retire, they're going to spend about $200,000 a year. They have $8 million of investments, $2 million in real property, $10 million total net worth. They're going to live about another 30 years. So when we look at the situation today, if they die now, no estate tax, no problem. But when that exemption drops in half and they've continued to earn money and build up for the next 10 years until they retire, they do have a problem, a $14 million problem based upon the growth rate that we've assumed, which I think was around 8% of growth rate in assets. So what can we really do for this couple to minimize their estate tax burden? We can do a bypass trust to use kind of the full exemption on the first death. That saves a little bit. But this is a situation where an annual gift plan and maybe a small gift to a trust makes a lot of sense. They have 2 kids. Those 2 kids might have 2 grandkids in 2 years. So we'll have a 4 total people that we can give to after 10 years. And by funding annual gifts, just $18,000 per beneficiary per year, in 30 years, that adds up to $18 million. Outside of their estate, 0 use of their exemption, took their estate tax down from 10 to 3.5. So this is one where annual gifting, made a lot of sense and significantly reduced the estate tax. If we add a discount feature on that, it makes an even bigger difference, down to 2.3 of estate tax. And then how did we zero out their estate? A simple $1 million gift was all that it took to zero out the estate tax for this married couple, with they continuing to do the annual gifting year after year. You can see here, they started after that gift, they have $7 million of investments left, 25 years. Sally still has 8.5 of investments, plus she's a beneficiary of the bypass trust. And then when Sally dies, she's left with 6.7 million of investments. So still plenty of leg room and flexibility there. So we didn't have to use $13 million of exemption. We didn't need the bonus exemption. All it took was annual gifting and $1 million gift. So that's the importance of just running the numbers. So next scenario, same situation. Excuse me. But instead of doing the annual gifting, we said, okay, let's put $4.5 million of assets into an LLC, and we sell that in exchange for a note, 30% discount on the installment sale. And you don't have to worry about the annual gifting. All you got to worry about now is making this one-time interest payment each year to the trust, or sorry, from the trust back to you. And that's going to freeze your estate at today's value. That's going to get your estate tax down to 0 because you're going to have to pay the income taxes on this trust as it grows in value. And this might be a better plan than having to remember to do annual gifts every year and the documentation associated with that, and finding the money to move, whether it's liquid or whether it's in kind. This might be a better plan. So there's more than one way to skin a cat, as they say, and the client you can have this discussion with the client as to which way they want to go. Now, this plan might be a little bit more expensive because you'd have to get a valuation report. There's a little bit more documents as far as setting it up. But as far as maintaining it after it's set up, it might be a little less burdensome, and the client might like this a little bit better. And it gives them flexibility. They have this note payment coming back to them. They could forgive that note if they don't need it at some point down the road, but it was an interesting kind of alternative to present as well. Alan, Joey, any thoughts there on this couple?
I love this model, because the other thing about it is if they come back in 2026 and say, well, the exemption went up, what can I do now? Well, you can just unwind. You're owed these promissory notes. Let's swap it back for LLC interests or assets. There'll be a little bit left in the irrevocable trust, but I think it makes, really good sense just to get these in place.
Yep. And I think too that brings an important point of basis. We haven't really talked about step up in basis yet. If we've gifted, these assets outside of the estate and we don't get a basis step up on those, and we didn't really need to gift them, then maybe we've lost a little bit of benefit from an income tax standpoint of getting a basis step up. Whereas, like Alan said, if you have this note in place, we could easily swap assets in exchange and unwind this, get the kind of appreciating assets back into our estate if we have a large exemption, then die with those to get a full step up in basis.
Yeah, and let me mention another reason to do these trusts, and that is if you've got grandma or old Aunt Sally with a 2 or 3 or 4 year life expectancy, you can make them a beneficiary of this trust and give them a power to appoint assets to creditors of their estate with the permission of your next door neighbor, who will never give permission. And then when they die, according to the Internal Revenue Code, you get a step up. So people say, what's the value of assets that I would need before a slat? And I say, do you have any elderly aunts or uncles? Do you have any appreciated assets? Because we may do this just as a basis planning move as opposed to an estate tax planning move. But for a lot of clients, we're just finding that this is icing on the cakes, and it certainly takes the sting away from missing Aunt Sally and going to her funeral and all, when you're also able to start depreciation again on your building or sell it without capital gains. You could name your new building after Aunt Sally. So what's the next hypothetical? And by the way, Brendan, are the viewers of these slides, I guess they can go back to the very beginning to see what your inputs were?
Yeah.
So at page 67, the inputs are the name, the year of death, how much they're saving, which is essential, how much they're spending at a certain age, which is essential, and then what their growth rate is, what their tax rate is, what their investment advisory fee rate is. We have all that in there. And it's really important to track all that. If you just do this on an Excel spreadsheet and you're not tracking all that, and it turns out they spend a lot of money, then you may undershoot or overshoot. So our final polling question, and Joey, are you making this happen? Okay. So this is our last salesy thing. But if you'd like to do a one-on-one workshop or a small group workshop, those are free, a 30-day free trial, all of the above, or a spinal tap, please elect. So 33% have elected spinal tap. So we need you to come here on Wednesday. Don't eat anything before you get here at 9 a.m. and we will give you a spinal tap at no additional charge. Okay, now spinal taps are down to 22%, and the 30-day free trial is the favorite. So thank you very much for that input. What's next, Brandon?
Yeah, so the next one here is.
Oh, and by the way, if you've completed that last polling question, you've been here more than 50 minutes, now you just stay on because you love us or you like the content, not because you need the continuing education credit.
Quick note, Alan, that's the third polling question. Did you want to do the fourth one now as well?
Yeah, we'll do the fourth one. Thank you for correcting me, Joey. Please don't do it too often. Okay. So what kind of programs should we concentrate on for the future? A, more math. B, asset protection and practical planning without math. C, advanced estate tax planning techniques without so much math. Or D, I would be willing to be interviewed to find out what our firm and EstateView should be doing. So 6% of you are willing to be interviewed. That's fantastic. And 67% want to hear more about asset protection and practical planning, and only 4% want more math. So our hearts are out to you for sitting through this, but the math is important, especially in these situations.
Yeah.
So Brandon, what page are we going back to?
Let's go to page, 82? No, farther, 79.
79, a very good year.
78, one more, sorry.
78, that was a good year.
Yeah, that's another great year. So this is married couple 3. They're aged 45 and 48. Again, have done no planning. They're going to save $350,000 a year until they retire in 25 years, and then spend $350 a year after that. They have $18 million of investments that they've saved over time. And then they have this explosive asset that's worth $5 million today, but they think it might be worth 15 in 5 years. $2 million home, and they're going to live around 40 more years. So that's kind of the basic assumption. So what can we do for this particular client? Because again, this is one of those situations, they die today, no problem, but they live to their life expectancy, they have a big problem, $200 million problem if we add up the numbers over time. So again, basic bypass trust planning is one option. They could put their home into qualified personal residence trust where they have the right to live there for a number of years. And then after that kind of retained usage term, it's outside of their estate, they can pay rent to continue to live there, which is a estate tax and gift tax free transfer to this trust that depletes their estate more, allows the trust to grow in value. So that is one option to help drive down the estate tax. Again, we have the annual gifting, and this is a situation where, yeah, you could probably use one spouse's full exemption. We'll get to maybe where you don't want to under this one, but here this is a large gift, $18 million of assets discounted by 25%. So gift tax value of 13.6 that goes into this gifting trust. And over time saves, we went from 200 million of estate taxes down to 40 million. So we've done a pretty good job there. Can we zero it out? Yes. What if we took that explosive asset and sold that in exchange for a note? And it only took about 45% of the explosive asset into a installment sale trust to zero out the estate tax. But let's take a look at this. If we gave away all of our exemption from one spouse, we gave away 45% of the explosive asset, what are they left with? If you look at the top column there today, 2.4 of investments and a $1.5 million note. Yeah, they're still earning salary from their company, so they're going to build that back up over time, but they may not be comfortable with that level of reserves. Maybe they're still giving away, too much in that situation. And that's where the installment sale might actually make more sense. So rather than giving away the full $13 million, we just sell 100% of this explosive asset in exchange for a note, and do $15 million into an LLC, discount it and sell that for a note. Then that gives them 1.6 of investments, but they're owed $14 million on a promissory note that can be prepaid at any time. And that gives them flexibility to, maybe in 2026, we see the exemption is going to go down and they forgive that $14 million note to use the exemption. But it's an option. It's not something that we locked them into today. We gave them the flexibility to use that full 13 million exemption if they want in the future by forgiving the note, but we gave them a lot more flexibility moving forward in the future if something happens where maybe they lost their job, maybe they got fired, and then they would come back to you and say, you only left me with $1 million. How am I supposed to live? Would it be much better to say, well, no, we actually left you with 15 because we can pay back this 14 if you need it today. And that, I think that's another one where the Biden two-step plan with the promissory note that we might forgive later makes a lot more sense than doing a large gift to a trust and doing like an annual gifting plan. Is let's just set up the Biden two-step installment sale. You can still zero out the estate tax based upon our assumptions, but it gives you a lot more flexibility moving forward.
Oh, I just want to mention that the Cupert sure is a winner when you take into account the rent that the client's going to pay after the term. If you look at this Cupert, not only are you getting $10 million worth of homestead out of their estate based on a relatively small gift, but the rent that they've paid and the growth on the rent is $47 million. And that's the real numbers, and that's very interesting. So, and the other thing is, when you take into account this explosive asset, you have to take into account how much income tax is going to be paid at the time of the sale. So that's going to reduce their estate, which is very important, which is why you don't always want to put the whole thing in there, because then they get a big surprise when the burn happens, when they sell a big asset out of that installment sale trust. Joey, anything to add to that?
Yeah, I just want to add that income tax on the sale, I believe you can use the installment method. So you only have to pay that tax as those payments come back, or is that not the case for an installment sale?
No, it's a grantor trust, so there's no income tax on the sale. But no, you're right. When they sell the business, when the inheritance trust sells the business, if they sold the business on the installment sale, they could pay the income tax as it comes, but that rarely happens. When you sell your business, you typically want all your cash at closing. But it's the other thing, though, is they could, the installment sale trust could convey the business to a charitable remainder trust, and then you could defer the income tax for up to 20 years, which is not unusual. Okay, Brandon, do you want to go ahead and put EstateView on your screen?
You have the screen, so it's probably easier to go on yours, or we can swap if you want.
Yeah, well, I'll just go ahead and open EstateView here. So I take on my browser, I go to estateview.link. EstateView comes up and it says hello to me. It's one of the only people that I'm on speaking terms with in the early morning. And if we go to the large gift calculator, Brandon, what numbers would you normally put in here to help a client see what to do with a large gift?
Yeah, I think let's go with the 70-year-old's fine. Let's say they got 25 million of investments.
Okay, that was easy to put together.
Yeah.
Yep. Okay.
And 7.5's fine, 2%'s good, and let's say they want to use all 13. Let's see where that puts them.
Okay. Click for results. This is our standard mode. That's the one that costs $199 a year. So they made a year one gift. estate tax savings was 13 million. They saved 983,000 per million gifted. So, and this is what it looks like. The blue is the gifting trust. The green and red are their remaining estate. And then the red is what the estate tax takes when we're all done here. So that does make sense. It doesn't look like they're going to run out of assets, does it?
Yeah, I thought that would be one that would be pretty close, but it's actually a little bit more room than I thought.
Right.
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 If we discount it, like if we had to put like 18 million of assets discounted to 13. Probably
Okay,
have to go to pro mode.
I'll go to pro mode now. That's the $499 model.
Yeah. And we haven't taken into account spending.
We haven't taken in, now we'll take into account spending. So maybe they could spend more or less. If they're going to spend more, it's going to be a little bit more challenging. And let's see, let's go to age 100. And oops, running out of assets there. See, it looks good until you figure out that they're going to live a long time. So he's going to run out of assets at age 90 from making this gift, assuming the spending that we're showing here. So what we could do though is we could say, well, you could toggle off grantor trust status and let the trust pay its own taxes. So I'm going to take the year to toggle off grantor trust status and move it from never to year from inception. So if the trust pays its own income tax from inception, you're going to have no run out of, you won't run out of assets, but you'll have a lot of estate tax. So I could say, what if I toggle off grantor trust status in year 20? Well, if I toggle off grantor trust status in year 20, then it's a much better situation, isn't it?
Yep. It kind of almost works out perfect there.
Right.
With almost 5 million. Yeah.
Right. And then I can show the client that without planning, their estate tax would have been 27 million. But with that 13.6 million gift, their estate tax is zero and they're leaving 90 million for their descendants. And if I toggle down the gift amount, then the numbers are going to change. So here I can show them the more your gift, every time I put in another million, that estate tax goes down. And the most I can give is the 13.610. So that seems pretty comfortable. Now I can, and here is the spreadsheet. So the spreadsheet shows a 25 million net worth that goes down to 11,390,000 after the gift. It shows no portability allowance. It shows the core exemption of 6.8 million, the temporary exemption of 6.8 million. Those go to zero because we use them completely. And then it shows you the burn, how much is coming out of their estate as the result of the burn. And across the top, it's showing me the results from that particular gift, which is not a bad gig. But the client may say, well, show me something else. Let's change something. What if my annual spending is 400,000 a year? Oops. If my annual spending is 400,000 a year after the 10th year, then I'm going to run out of assets. So what do I have to do in that scenario number 2 with the larger spending to make this work? So I go to gift number 2 here, and again, that's where the terror impacts. But even with $400,000 of gifting, if I toggle off grantor trust status, well, in year 13, I'm okay. So it's not so bad. But let's go to another person. I'll click that. So now I've got person number 3 across the third line there. And let's say person number 3 doesn't spend quite as much, but they also don't have quite as much. They only have 29 million. So I can show them if you give 6.5 million, your net worth of 19 million 5, if you give 6.5 million, it goes down to 13 million 9, but you haven't used your core exemption. So when your temporary exemption disappears, your exemption it hasn't been used based upon use it or lose it. And the timeline for that for gift number 3 looks like that. So what would you do for this person, Brandon?
Yeah, I think they could possibly afford to give a little bit more, right? Because they're not running out.
Yep. So I'll click up the
there we go.
So they go to 11.6.
That's a tough crossover. Yeah. 96, 95, they're running out of assets.
Yep. Yep. Now the other thing, and we don't need to get into this now, but they could sell assets for a private annuity. So I can click on private annuity sale. And this tells me that if I start a private annuity in year 10, when the person's 80, then for every million of assets he sells to the trust, he'll get 149,000 a year. So he won't run out of assets. It may look like he ran out of assets when that happens, but he's still getting those payments of 149,000 a year. And what I can do is say, well, if he sells 1 million 10 years from now, it will extend it. So just so he knows, that's something we could do in 10 years. Now, what would it look like if we did it in year 5? I can click down from 10 to 5, and then it's a little bit more problematic. So, that's how we look at it. But then the other calculator that you ran was the installment sale with income tax analysis, right?
Yep.
So there's the other way to look at it. This is a simpler way to explain it. It doesn't have as many bells and whistles, but it does show you what the person starts with, what the burn is, what they have, and what the what the estate tax savings is each year based upon whatever year they die. So any comments on that?
Yeah, run that one out to 30 years and let's see where we end up with this sale. So it's $25 million of assets, 8% growth, spending $800,000 a year, and then they're doing a $6.8 million sale with 35% discount, 4 million note. So not a big sale.
No, we could crank up the sale.
Yeah, let's see. Did they start running out of assets, or does that leave them? Yeah, no, they're still just about breaking even. Well, yeah, age 100, they're starting to deplete, but looks like they need to do more in this scenario.
Yeah, so all I have to do is click up the sale amount, and it automatically clicks up the sale value, and it automatically clicks up the promissory note. And then they run out of assets at age 98. That's a pretty good balance.
Yep.
So, by the way, there was something else I keep forgetting to talk to you about, and that is, a lot of clients are concerned about the nursing home insurance or what it would cost to be in a nursing home, and will they have enough? What do you think about if we get a proposal from a nursing home insurance carrier saying, if you pay us these premiums, you'll get these benefits? And what if we enter into that contract between the grantor of the trust and the trust at arm's length? So the grantor makes those premium payments every year to the trust. It's not a gift. And then the trust provides the grantor with nursing home expenses based on what the policy would have provided if the grantor needs the nursing home expenses.
Yeah.
I think that would be
self-insurance policy for long-term care.
Right, right. I think that would be, you know, very protectable. Are there any questions that we should answer for the attendees before we show a little bit more of EstateView?
We did have one about whether or not you keep your step up when you transfer a residence to a Cooper.
Right, and the answer is if you die during the possessory term, you keep your step up. If after the possessory term, Aunt Jane has a power of appointment over the trust, you'll get the step up when she dies. But when the grantor of the trust dies after the possessory term, the IRS says in Revenue Procedure 2023-2 that you don't get the step up. Now, Brandon and I think that there's a good chance that you do get the step up, but that can be a sticky wicket. And when we go to estate tax planning conferences, the speakers normally say that there's no step up, but the speakers don't sign your income tax return. Your CPA signs your income tax return. Were there any other questions? I don't think so. Brandon, do you want to take control of the screen and just give a quick tour of EstateView for anyone who might be interested in it? So if you're interested in EstateView, just send us an email or go to the EstateView website at estateview.link, or go to estateview.info and that will take you to estateview.link if you like. And then Joey, what's the password for a free 30-day trial with a 5% discount? It's should I find it on the PowerPoint?
So we have free trials, the free 30-day trial. So when you go to sign in, it'll ask you what version you want of EstateView. We recommend you start with Pro Plus. That way you can see everything it has to offer. And once you click that, there's a place to add a promotional code in Stripe's portal. So you just click add promotional code and type in free trial. And that'll get you your 1 month free trial.
And is that one word? Is that one word, free trial?
One word, and then it's automatically all capital letters. And so it'll be free trial right when you type it in.
Yeah, and if you email us and say I did this, then we'll make sure we track you, that you get your 30 days, and that we'll bother you on day 31. But the best thing is do a call with Joey, and he can take you through. But for example, you go to married couple there. I just clicked on married couple, and my inputs are down on the left. As you can see, there's not that many inputs that you need to do, and once you have the inputs put in, you can go ahead and just click on dies in year 1, what happens, dies in the second death, what happens with no planning, what happens with a credit shelter trust, what happens with 1 or 2 Cuperts, what happens with annual gifting, what happens with discounted gifting, what happens with life insurance trusts, what happens with a large gift, what happens with an installment sale, and what happens with a CLAT. So it's definitely worth the time to learn how to use this, because then you can generate a letter for your client which has all this information and explains how all this works. The software is web-based, but the data all stays on your computer or your iPad. So you can always come back to it. You can save it, you can share it, but I think it's worth the price of admission for a free trial just to run this on people. Even if they're not estate taxable, put these numbers in and see how much assets they're going to pass when they die. But if they are estate taxable, then you've got all these numbers. And one of the things to check, and this is why I favor those self-canceling installment notes, is that it shows you what the estate tax would be if they die before that second death. And if you are using self-canceling installment notes on your installment sale, that red goes away or can go away for the term of the installment sale. The other things that we do with EstateView, before I even see a client, my secretary or one of our legal assistants will go ahead and run their life expectancy numbers. So if it's a 70 and a 72-year-old, I can tell them, hey, your table life expectancy is about 15 years for the 70-year-old, 14 years for the 72-year-old, but there's a 50% chance that one of you will live at least 19 years. So that's good to know. And then if the client may be interested in life insurance, it's nice to be able to tell them what the term rates might be. So if, for example, the client is 64 and you think they may need 3 million of life insurance so the surviving spouse doesn't go hungry, you can tell them that a 10-year level term policy may cost between $20,000 and $13,000 a year, assuming they're non-smoker, or what a universal may charge. And we're going to be adding guaranteed universal life. We don't sell life insurance, but it's nice for an estate planner to know what these things might approximately cost. And then my secretary also knows to go to the RMD calculator. And if the client has a $3 million IRA or pension and will illustrate to age 100, let's say that the client is age 67, I will click on results and it's going to run a nice little spreadsheet that shows me the growth rate of the IRA and what the required minimum distribution payments will be each year. And the clients like to see that they're never running out of this IRA. It's still worth $3 million when they're 102 years old with a 17% payout, but they are going to pay a lot of income taxes on these payments. So then the next thing I can show them, I can go to duplicate and go to my Pro Plus here and say, well, what if when you start taking these minimum payments, you give $25,000 a year to charity directly from the IRA, which isn't taxable. So now the spreadsheet is going to show me what goes to charity, indexed for inflation, and what the income tax savings are from letting that go to charity, $734,000. So charity is going to get $1.9 million over time, but Uncle Sam's paying for $734,000 of that. Or they may want to make larger charitable contributions, so I can go to 105, and they may want to start now. So I could allow the charitable contribution to exceed the RMD. So now the charity is going to get $8.7 million. The clients are going to get $4.5 million, and Uncle Sam is going to get $3 million less. So the secretary handles that, and I just show up at the meeting with 3 spreadsheets to show them those 3 things. Now, by the way, for all our spreadsheets, I just click on Export to Excel, and then the Excel spreadsheet opens, and it is, of course, you can send it to the client, or you can take screenshots of anything you see here.
And Alan, I think I'm glad you mentioned the qualified charitable distribution, because I think that's one that's underused by a lot of people, that particularly those large clients with large IRAs, and that are charitably inclined. If you give from your personal money, you have to deal with AGI limitations. You're probably not able to deduct the full amount unless you're still kind of in a significant income earning age, which most people that have large retirement balances are nearing retirement and maybe don't have a lot of income to even take advantage of taking that charitable deduction. Right. So using from the IRA is a dollar for dollar deduction against your RMD, essentially, that is going to come out anyway. You're going to pay taxes on, and you direct that to charity up to $105,000, I believe it is this year. And you don't have to worry about your AGI limitations. You get a $105,000 charitable deduction off your IRA. So nice way to kind of deplete that IRA as well as benefiting charity if you have, charitable inclinations.
Right. Then another thing I can do is I can go to the Monte Carlo calculator, and I can simply say, well, if you've got $1 million and it's 35% in bonds, 65% allocated equities, and you've got a 25 or a 35-year period of time, then I can click on results and say, look, based upon the history of the stock market, there's a 1% chance that your rate of return is going to be under 3.25%. There's a 10% chance it's going to be under 6.12%. a 25% chance it's under 7.75%, an average of 9%, but then it could be there's a 10% chance it could be 13% or more. So then I can run my numbers on these, because I mean, this takes into account that you could invest in a terrible year. If you have 2, 3, or 4 terrible years right after you invest, your result, even after 30 years, may only be a 3% rate of return. Or if you invest and have, you know, in the very best years in the beginning, then you could end up with a 16% rate of return. Because I think we may do a disservice when we tell a client, oh, 7.25%, that's what you're always going to earn. Well, in bad years, it's not that good, and in good years, it's not that bad, right? Then there's the NEST calculator, where I can show my client that what they spend in various things, what they save every year, the size of their house, the size of their investment portfolio, the amount of their debt, ends up either allowing them or not allowing them to meet their retirement goals. So this person, age 40, with a spouse age 38, saving $180,000 a year, with all the different things that they have going on in their life, could retire if they want to at age 58 on the amount that they want. They wanted to die with $1.5 million for their children, and they want to be able to retire at $175,000 a year. But let's say, so that's number one. But let's say these same people decide that they're going to do what a lot of people do. They're going to have not a $7.5 million house. They're going to have a $3 million house. And in order to do that, they have to have more debt, of course. So I'm going to go to, where's debt? I'm going to go to debt. Debt's here somewhere. Debt, investments, one-time additions, debt. I'm going to take debt now up to 2.8 million. 2.8 million. And now what does that do to their retirement plans? Well, it's not as bad as I thought. Now they can retire at age 60 because of the growth in that home, but I must be using a low interest rate. But anyway, that shows, oops, with number 2, it's not so good. They're in a deficit. So they won't be able to retire. In fact, they'll run out of assets pretty quickly. So they shouldn't do that. And by the way, here's how much life insurance they need at any given year for the primary bread earner. So then I can go from there to my life insurance estimator, and I see that this 38-year-old needs $7 million of insurance. So I can click up to $7 million, and then they've got a budget for another $4,000 to $5,000 a year of premiums. So that is the NEST calculator. Then I want to check the news to see what's going on in the news area. And I can see here that the IRS gave another limited estimated corporate AMT underpayment waiver. Supreme Court insurance proceeds increase corporations' estate tax, et cetera, et cetera. Maybe I'd like to get a summary of these articles. So there's a summary of the article, and maybe I'd like to, instead of seeing Bloomberg Wealth, I'd like to see Google News Business. So I can do that. That's another one of our little features. And then self-canceling installment note. So Brandon, what numbers do I want to show here?
Let's see. So sell one, 70-year-old. Let's see, yeah, pro plus it. Yeah, let's use 65-year-old.
Yep.
And term of note can be 20 years, right at their life expectancy.
Yeah, and let me mention that a lot of people think the life expectancy on a self-canceling installment note is the maximum term of the note, which would be 19 years here. But Jerry Hesh has assured me, and I believe him, and I've read about it, that you could go longer. The other calculators don't let you go longer, but ours does. So brag, brag, brag. So we'll go 22 years.
Yeah.
And we'll illustrate 35 years. And we'll go with a self-canceling installment note where the interest will be grossed up so that it is an arm's length transaction. And we could make a year one gift to a trust of $1 million and then put $15 million worth of assets into an LLC, take a 30% discount. So we're going to sell for a $10,500,000 self-canceling installment note. I click on see results, and then this shows me that my risk amount here, and this is for the 70-year-old. So I guess I'm on number one.
You're on number one. Yeah.
I'm on number one. So the interest rate is going to be 8.575%. The annual payment on the note is going to be $900,000 a year. And the estate tax savings resulting from this, even when the person dies in year 20, before the note comes due, the estate tax savings is $54 million. And then the spreadsheet of the money that goes into the trust indirectly through the discounted LLC, and how much the payments are, and of course how much the burn is, are all shown here. And then if I want to get a better idea of what happened here, I can click on SCIN 1. I can get a PowerPoint presentation, an explanation, and a planner's checklist, put my name in there, put the client's name in there, and open it up. And then this shows the $1 million gift, the $10.5 million sales price, the interest rate of 8.57, information about how a SCIN works, and also the outcome, the estate tax savings outcome, and the spreadsheet. So that one's working nice. Brandon, Joey,
I think one of the cool things that you can do on EstateView there is going back to that same situation. What if you did note 2 and just did a conventional note with the same kind of inputs? What does that look like? So when we can compare, say, hey, if you wanted to do a conventional versus a SCIN, what is that,
Okay, so I've got note 1 here that I just did. So I'm going to click duplicate. So now column 2 is the same as column 1, exactly. And I'm just going to change one thing. I'm going to change the note from self-canceling to conventional, interest only. And the estate tax savings are actually better. And the reason the estate tax savings are better is because there's 20 years of interest returned to this person. So the estate tax savings are better. Now, if the person had died in, let's go back to the first one, and let's kill the person off earlier. So year of death, instead of age 85, let's go to age 75 for year of death. And then on the second one,
yeah, you changed the second one, so you have to go change the first one now.
So the first one, year of death to 75, and now you have saved more on the SCIN than on the non-SCIN.
Yeah. So I think that's a pretty important, pretty cool feature of EstateView, is the ability to compare, similar transactions with different features, side by side, and that way you show the client is, hey, like how it's a horrible conversation to have with the client talking about dying early, but how bad is your cancer diagnosis? Are you going to live 10 years or are you going to live 20 years? If you live 20, maybe we're better off without a SCIN. If you live 10, we're better off with the SCIN. So what is your risk tolerance? What is your health outlook? Because it can make a difference and we can see how material that difference is, so we can, you know, have an informed discussion with the client of which direction we want to go here.
Right, right. So, so that's the self-canceling installment note, which I think, Brandon, we need to go ahead and make sure that we have slides on those hypotheticals you just showed with a SCIN in the first years, so that in the first years, if they die early,
Yeah.
We don't have the same issue.
And you can go to the same timeline view too, right, to see when that crossover point is on the various notes when you're comparing them with the timeline view is another feature that's.
Is that in there right now? So timeline. Yeah, yeah. There's the timeline. There's what's in the trust. The green is the payments coming out, and the red is the lovely estate tax, depending on when you die. So you definitely want to die early so you don't end up in there.
Yeah.
I remember I wrote an article once called "When to Unplug Great Grandpa." I don't think I think I did mention SCINs.
Yeah, that article is going to be relevant at the end of 2025 again, so we can brush that back up.
Yeah, now it'll
plug early. Don't let them live past midnight on 2025, because then you would lose half of your estate tax exemption.
Right, right, exactly. So then we can also try the private annuity. So with the private annuity in the simple mode, a 70-year-old who wants to do a private annuity puts $3 million into a trust in exchange for a private annuity. So the annual payment he's going to get back for life is going to be $317,000. Now, when I go to Pro Plus, and Joey, we need to change it so that standard includes the exhaustion test, if you want to make a note. But then this tells me in order to do that, the trust has to have a value of $4,997,000. So basically, this trust needs to have $2 million in it before I transfer $3 million in exchange for the private annuity right. But you know, most people think the private annuity is set in stone, and that you can only do the private annuity for life in equal payments, and that's not correct. You could defer the first payment. In fact, that's what Mrs. Kite did. She didn't get any payments for the first 3 years, and she died in year 3.
Mm-hmm.
So I could defer the payments to year 6, and then I could say that instead of level payments, I can have them be graduated at, say, 4% a year. So now you see no annuity payments until year 6. Now, as long as there's no particular physical condition that is likely to cause death within 1 year, as long as there's not more than a 50% chance that any one health condition will take your client down within a year, you can use these standard tables. So the client puts $3 million into this trust in exchange for the private annuity, makes a $2 million gift, dies before the end of year 5, and there's no estate tax whatsoever on the $3 million. But the client's going to get back $500,000 in year 7, $550,000 in year 8, etc. So it's going to backfire if the client lives a long time. But we see the estate tax savings from the arrangement. A lot of the estate tax savings is from the burn, just paying the income tax on behalf of the trust. So just before I forget, so we can remember what we did here, I can go to the general explanation, print my PowerPoint presentation, click submit, and then it's creating the PowerPoint for me. Usually it's faster, but I think it's going slow for me. So then I click there, and there's the information. So if anybody requests this today from the webinar, the explanation is there. So I think we've probably stayed the right amount of time. Let me go back to the PowerPoint, because I know some of you are interested in this software. We're going to get a lot of questions that I think I can, well, let me see if I can find the PowerPoint. It is right here. Okay.
On the screen, yeah.
Yeah. So if you are interested in EstateView, if you want to use it for free, put estateview.link in your browser. It'll take you to the software. And then can they use this promo code, Joey, webinar50FF?
So that would get you a 5% discount if you were to purchase it today. But if you want to use the free trial, it would be the promo code free trial.
Right, right. And then just tell us that you were on the webinar and you want the 5% discount if you decide to buy it. And there's 4 versions. $199 a year pretty much does what all the other calculators do. Plus you can compare them, and it does give you the spreadsheets. The Pro version does a lot more. The Pro Plus does everything, and that's what the vast majority of people are buying Pro Plus. I would say 94% are buying Pro Plus, 6% are buying Standard, and then no one yet has bought Pro Elite. But Pro Elite gives you Pro Plus 4 hours of tax lawyer time and 30 hours of video editing, where you can do videos for your clients, and then those videos are boiled down into letters that summarize what you said and what each of the screenshots were. So this is so effective that Brandon is choked up.
Gets material.
Yep. So I hope I see you Thursday, June 20 in Orlando at the Florida Bar Convention on what to do with family members. Thursday, June 27, I'm going to be with Tom Dixon at the Financial Experts Network on estate tax planning. And then let's see here. I'm looking for the Saturday webinars on the family business. So beginning Saturday, July 20, I'm going to start a 3-part Saturday webinar on planning for the family business. It's not a calculation webinar. It's not about EstateView. It's about all the different things you can do for a family business. Thanks again, Brandon and Joey. Thanks to all of you who stuck around till the not so bitter end. Have a fantastic rest of your weekend. And I hope, in the words of Steve Weinberg, that you use what you've learned here to help others. Thank you.
Happy Father's Day to all the dads out there tomorrow, and hope you guys have an enjoyable weekend.
Yeah, and I hope you buy your father an expensive gift.
Like EstateView.
Like EstateView. I mean, that would be, yeah, exactly.
Take care.
All right, bye.